What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are talking where the economy is, the state of the economy, and just what is going on with everything here. So we cover a lot of different insights we're looking at in today, kind of summarizing a little bit of everything here. So if it's everyday video or just curious to know what is going on in our economy right now, feel free to like the video, subscribe to the channel, and turn on the bell notifications for all future uploads. Now, the first thing I want to bring to light is this article from CNBC that was posted 2 days ago. Trade war fallout. Cancellations of Chinese freight ships begin as bookings plummet. Now, again, obviously, if you are new to the finance game, I mean, maybe someone being up to date with the tariff news and how Trump is talking about tariffs and what's going on between us and China and everything else. And how he we had this huge euphoria moment where he paused all the tariffs on a lot of the countries and the stock market was up 10% a day. And he was so happy and he was tweeting about it and putting on Truth Socials and everything. It was just euphoria, because right now I think where we're at right now is just absolutely wild here. So again, I'm going to give you some insights, look at some data, look at some articles and everything else here. Again, keeping my political views out of it, of course, as per usual. I'm just giving you guys the facts of what I see here. And I will give you my opinion, obviously, that I'm not anywhere optimistic for the rest of the year for the economy here. I don't see any of that possibly happening here. We've got big Wall Street analysts are downgrading and revising what their predictions were for the market for the year, and almost all of them were a lot lower than what they expected at the end of last year. I'll put that graphic up on the screen here for you guys as well. I haven't seen, and I guess maybe I can say I have seen, there's one focus that has this economy propped up right now, and it's the labor market. And we'll talk about that more a little bit later on here. But this is interesting to think about, because I didn't even see this post anywhere. I heard it from somebody else online, and I went and I found the article for it. The number of canceled sailings of freight vessels out of China is picking up as ocean carriers attempt to manage a pullback in orders due to the trade war and tariffs. A steep decline in containers being shipped to the U.S. will have a big impact on the supply chain, from port to trucking, rail, and warehouse economics. We won't go to zero containers, but we will still see a decrease in containers as a result. In the future, we will see a massive raft of blank sailings announced, one freight expert tells CNBC. And this right here, when I read this, I was like, oh boy, oh boy, oh boy. And again, as we go through anything here, feel free to leave your comments down in the comment section as per usual. Again, we'll keep it civil. I don't respond to you. You know, when you give me your insight, I give you my insight. Am I a Wall Street expert? Of course not. Am I a financial analyst? Of course not. But again, I have a lot of things here that kind of have helped me come up with my conclusion as to where we're at and where we could possibly be going. So we justify our own views and our own viewpoints. I have mine. If you have your own, then obviously you have your own. A steep decline in containers will have a big impact on supply chain, from port to trucking to rail and warehouse economics. Keep that in mind. U.S. importers are being notified of an increase in canceled sailings by freight ships out of China as ocean carriers try to balance the pullbacks in orders resulting from President Trump's tariffs and the escalation of tensions in the trade war. A total of 80 blank or canceled sailings out of China have been recorded by freight company HLS Group. It wrote in a recent note to clients that with the trade war between China and the U.S. leading to a demand plummet, carriers have started to suspend or adjust trans-Pacific services. And then this is also you're like, oh, 8,000 is nothing, right? If each sailing was carrying 8,000 to 10,000 TEUs, which is your actual storage containers, so 20-foot equivalent units here. That's what what TEU said. I didn't know that. That would equally decline in freight traffic of about 640 to 800,000 containers. Okay, and lead to decreased crane operations at the ports, lower fees that could be collected, and declines in container pickups and transport by trucks, rails, and to warehouse for storage. So think about what this is really covering here, right? You have 6,000 to 800,000 containers not being shipped over to the U.S. from China. It's okay. You have less crane operators. You don't need as many. Potential layoffs. You don't need as many people to transport it from trucks, from railroads to warehouses. You don't need as many people doing that. Potential layoffs. And remember, The big thing that I think right now has been holding up this economy for the longest time has been the labor market. Jerome Powell said the labor market is strong, the labor market is good, the data looks great, unemployment's pretty low. Like that is what is I feel like is holstering this economy. Like imagine like there's like you have a huge cut on your arm and the band-aid that's keeping it is literally the labor market right now that we're at. More disruptions to this labor market is going to be a problem. And this right here could be the start of that because you don't need to hire as many people because you have less options, you have less containers being shipped over, right? And also think about this, right? If you have objects being shipped over from Walmart from China over to the US, right? You have less supplies, you have less things going into Walmart stores. You have less sales. It eats your profit margins. You don't need to hire as many people. You start to lay people off potentially. The job market could start to crumble. And again, I'm not going to say that when it's going to be. It's not going to be next week or next month, but you might see it in a little bit longer period. You might see that happen, right? So just absolutely crazy that that's what's going on here, right? Another thing that's important is it's just bad news on bad news. The World Trade Organization slashes the 2025 trade growth forecast, warns of a deeper slump. The WTO sharply cut its forecast for global merchandise trade from a solid growth to a decline on Wednesday, saying that further U.S. tariffs and spillover effects could lead to the heaviest slump since the height of the COVID pandemic. And the difference that we're facing right now, right? The COVID pandemic that we had, no one could have expected it. No one knew it was going to have such an impact the way it does. And then we're going to have to shut down, companies and flights and transportation and everything shut down. The whole world basically stopped. Like nobody knew that was going to be the case, right? That was something that was not from it's not like somebody was single-handedly hit a button, was pandemic, boom, that's it. Where we're at right now is the administration has put us into a slump of a pandemic level slump that we had in 2020, but it's with his authority and his power he's doing it. He's causing these huge disruptions, not only in the U.S. economy, not only in the China economy, but in the world trade that we have right now. And we're going from a growth to a decline. The World Trade Organization said it expected trades in goods to fall by 0.2%, down from the expectation of 3.0 expansion. I'm very concerned. The contraction in global merchandise trade growth is a big concern, WTO says. What else do we have here? So U.S. President Trump imposed extra duties on steel and cars, as well as that. His trade war with China has also intensified, with tit-for-tat exchanges pushing levels on each other's imports by beyond 100%. I like how they call it tit-for-tat, basically saying, again, like people have been calling it, it's a big game of chicken. Who's going to cave first? And as we know, China has not backed down. China has reduced exports from cargo ships over to the U.S. They suspended, I think it was postal services or something. I think it was Beijing. I'm not really quite sure what it was in that one. I have to go back and find that one. And China's talking now to more other allies saying, hey, go to these places. Hey, they're starting to bolster up their trades between Asian countries, European countries. There's that kind of offset what's going on between China and the U.S. China's not backing down. They're not just oh, okay, sorry. They're not backing down whatsoever. And I think the big problem with this whole thing, and this is now my opinion here, okay? And you can take it however you want. My opinion is this. He said we're not going to pause tariffs. We're not going to lower them. We're not going to pause them. We're going full steam ahead, and that's it. That was Monday of 2 weeks ago. Then on Wednesday, it comes out and says, we're going to pause tariffs. 2 days after saying that he's never going to change it and that we're going to have to just bite the bullet and go for it. To me, he showed his hand too early. He had his cards and he showed it way too early to other countries. Not to us. Well, to us also. But he also showed his hand to other countries. They saw how quick he folded because of what the travesty would have been for the U.S. economy. And rightfully so, because if he didn't fold and we kept this going on here, we could have had a huge depression, right? I know I made a video about it recently about how the difference between a recession and depression. Trump was like, I'll take a recession, just not a depression. So that's why he paused rates, right? Or paused tariffs. But other countries are like, dude, like they're probably looking at this guy and being like, this guy has no idea what's going on right now. Like, why should we cave to this? Because he's single-handedly pushing his economy down. Why should we give into this whatsoever? He should be the one trying to negotiate with us more. So I feel like he showed his hand way too early with that one. And the fact of him saying that he's going to do tariffs, then he paused, and then he cut him back, then he did this, and it's the art of the deal, they always say, and stuff like that. It just, I think he showed his hand too early, and I think he had no idea the expectations that was going to happen here. And that is essentially what's going on here. Besides that, though, the World Trade Organization said that if Trump reaches the full rates of his broad tariffs, that would reduce goods trade growth by 0.6 percentage points, with another 0.8 cut due to spillover effects beyond U.S.-linked trade. Wow. Taking this would lead to a 1.5% decline, the steepest drop since 2020, again, COVID pandemic. If we have contraction in global merchandise, the concern is spillover into broad GDP growth. We've seen the trade concerns can have negative spillovers into financial markets, into other broader areas of the economy as well. She also raised the alarm about the impact of developing countries. So that's just crazy. And again, hey, look, container cargo ship. Great. We just covered an article about that, right? Just absolutely wild. And again, now Yahoo Finance, we got Reuters coming out with other articles saying, hey, the probability of a recession is now 45%, which take it with a grain of salt because JP Morgan said it was like 60, or Goldman Sachs, when it was like 60, now it's a little bit lower. Again, this is talking about the same thing. We're talking about how we're looking at a 50% chance, according to economists polled by Reuters. So people who have years and years of research and understanding and data behind it for economists polled by this. The pause didn't do much because we're back to where we're at. We pumped 10%. Now we're back down like 4 or 5%, whatever it is. It didn't really do much. It was a temporary euphoria that we had here. Just nothing's really good here. And again, now the probability of a U.S. recession over the coming year has surged to 40%, the highest since December 2023, from 25% last month. So it's up 20% in the last month here because of this. That's the real issue for U.S. growth that raises the recession risk. Lack of clarity on the trading environment faced by U.S. companies makes them naturally more worried about putting money to work in the U.S. economy. And this right here is just like, to me, I see this over and over again, right? From small businesses to large companies, whatever it is, they don't know what to do. That's the gist of it. They have no idea what to do. They don't know how much of these tariffs are going to implement and how they're going to impact their margins, their profits, their supplies, the demand. They do not know. And Jerome Powell's the same thing. He has no idea. He has to wait for data to come out to see what happens before anything else really happens. Companies don't know that either. Small or big, doesn't matter. And again, they don't know. Should they put more money into the economy? Well, if they put all this money into spending and making things in the U.S., but the demand goes down, you just lost a lot of money there, right? You put millions of dollars into your company to produce goods and services in the U.S., and then the price is so high, the demand isn't met, then you're out money. So that's the thing that people, that's like a standstill we're at right now, in this case. And it just doesn't seem like it's going to be good. So another thing to think about, right? There's also another U.S. debt downgrade warning. That came out, I think, on Tuesday. That came out on Tuesday when this article came out here. It's not America. I like how he starts that off. It's not America's year. You're right. Amid a damaging trade war, a wobbly stock market, and global sell-off of U.S. assets, there's a new warning that gargantuan debt levels and political dysfunction could trigger another downgrade in the nation's once bulletproof credit rating. So again, imagine that you have your credit rating up to 850. They have it as a economy as looking at the America also has a credit rating, again, because we do a lot of borrowing for money, and so we borrow debt and stuff like that and everything else, right? In an April 14th report, S&P Global Ratings hinted that it could lower the U.S. credit rating, currently at AA+, by another notch if any of the number of things happen to make the U.S. fiscal situation worse. It's a good bet that some of those things will happen. Awesome. The outcome of the U.S. government's budget process and policy negotiations over the coming months will help determine policies that inform our views of the U.S. sovereign creditworthiness. These discussions could affect our view of the U.S. fiscal policy or fiscal profile, basically saying that like we could downgrade the actual credit rating from the U.S., which is absolutely wild. Which again, I also would not expect. They were the first ones to cut the rating back in 2011. Okay, that's cool. Fitch had it a couple years ago. I remember this. I did the research on it. Back in August of 2023, Fitch came out and downgraded the U.S. rating from AAA to AA+, and the market came down 1.6% for that month. And that was just on a small level. That was just like, that was a shock to like hit and like, oh my God, what's going on? And the market came down almost 2% for the month. Now we have tariffs, we have inflation, we have recession risk, and this, like, it's just lining up for a disaster, right? So just another crazy thing to think about is that you might have a credit hit as well. It, and then there's even more things, right? We talk about this, and Jerome Powell calls this soft data with expectations, consumer expectations, something like that. But these are things that covered on my live stream the other day, and it's also very, very important things to understand. The median inflation, this is from the New York Fed, by the way. So we have the New York Fed, we have the University of Michigan, we have all these different ones that do with consumer expectations, right? What would we predict to happen going forward? Median inflation expectations increased by 0.5 percentage points to 3.6 at the 1-year horizon. We're unchanged for the 3-year, and we're down for the 5-year. Great. Hey, 3-year and 5-year guys, we're good. Awesome. Love that. But the 1-year up 0.5 to 3.6% inflation in the year ahead. Could you imagine if like PCE or CPI comes in at like 3.5, 3.6%, what that will do to the economy with the stock market? Crazy. Consumers' year-ahead expectations of their household financial situations deteriorated in March, with the share of households expecting a worse financial situation in 1 year from now rising to 30%, the highest since 2023. People are afraid. People are panicking. Am I going to get laid off? Am I going to lose my job? Remember what we talked about, right? The idea is, Jerome Powell says the labor market is strong. It's going good. Initial jobless claims came in lower yesterday. That's great. But continuing jobless claims went a little bit higher. Unemployment's at 4.2% still. It was at 4. Then it went to 4.1. Now it's 4.2. The minute the Fed sees the labor market start to crumble is when they're going to make a pivot and start to do these rate cuts and everything else. Until then, I think nothing's going to happen. Nothing's going to change. We'll talk about that a little bit later on as well. Mean unemployment expectations, or the mean probability that the U.S. unemployment rate will be higher 1 year from now, jumped by 4.6 points to 44% in March, the highest reading since April of 2020. Hey, COVID time. Look at that. We're looking at going back to COVID level stuff, man. It's crazy to think about what's going on. The mean unemployment expectations would be 44%. Well, for the probability of it being higher would be 44%. A year from now. The mean perceived probability of losing one's job in the next 12 months increased to 15.7%, the highest since March of last year. That's fear. If that's not fear, I don't know what it is. Like, things are jumping up right now. People are like, am I going to get laid off? Am I going to lose my job? What's going to happen with unemployment? Like, it's fear, guys. And it's not something, again, I like to sit there and I would love to look at both sides of things. I cannot, and I've been saying this to people on all social medias and calls and podcasts and everything, I cannot find a single thing to be like, we're going to pivot. We're bullish, baby. We're pushing back up to higher levels. I have not seen anything. Just nothing. I have absolutely nothing. Inflation is still higher than it is. Inflation is still sticking around higher than what the Fed wants. We have GDP growth slowing down, could contract, could go negative. We have recession fears going on. We have a trade war going on right now with China. We're impacting other countries as a result of it. All it takes is the labor market. And who knows what will happen after that? I have no idea. Again, this is also the University of Michigan, which came out a little bit long ago. But again, consumer sentiment is lowest. Again, came in lower. This chart is really, really awesome to look at. Shares of expectations rising, highest unemployment. Rising unemployment up 5 straight months. Look at this, dude. This is higher than COVID. This is back to the housing market we're moving up to. With the housing market crisis, the dot-com bubble, we're in uncharted waters here with this. It's crazy. And again, you read through all these different things. And now the one thing to make a note of was that these were all done before the tariff reversal that happened in April 9th. But the year-ahead inflation expectations surged to 5% last month to 6.7%. The highest since 1981, and making 4 consecutive months of unusual large increase of 0.5 or more. Consumers report multiple warning signs that raise the risk of recession. Business conditions, personal finances, incomes, inflation, labor markets all continue to deteriorate this month. That's the university. Again, this is all soft data from Jerome Powell, but it is what it is. Then Powell comes out on Wednesday, and this is like, this is gonna be tough for us, guys. Slow growth and inflation. Oh man, why do you think markets sold off on Wednesday? Wait for greater clarity. He expects Trump's tariffs to generate higher inflation and slower growth. That's stagflation right there. You have higher inflation, slower growth, and higher employment, and stagflation. It's not going to be anything too good there. We may find ourselves in a challenging scenario in which our dual mandate goals are intentions. So basically trying to figure out, like, are we going to get to a point where inflation or unemployment, which one do we focus on now? That's what he's talking about, like having a dual mandate goals. He wants to have maximum employment, lower inflation. He's now saying, I don't know what's going to happen. There's a strong likelihood that the economy will be moving away from both the Fed's goals for the balance of the year, or at least not making much progress. Yep. Okay, cool. Knew that. What the Fed wants to do in the scenario is to consider how far the economy is from each goal and then potentially different time horizons over which of those respective gaps would be anticipated to close. Basically saying, which one can we tackle more? Unemployment or inflation? If it gets to that situation, it's a tug of war about saying which one can we tackle first. Who knows? Powell also spoke about the recent turmoil in the bond markets as yields soared to 2% on top of Liberation Day. Okay, cool. He attributed the turmoil to the markets processing a historically unique development, continued volatility, of course. The Fed chair, again, reiterated the independence of his institution and his own job, saying it's a matter of law and pledged not to act in response to any political pressure. This is actually very important because Trump the next day was just like, I can't wait for Powell to be fired. It's like, okay, dude. I'm pretty sure he's the one that hired him back in 2018. I could be wrong, but I think he hired him as the Fed chair for this pace. But he wants to avoid what happened in the 1970s. Fridge, what happened in the 1970s? You weren't born yet. You're right. But when you research things, you look at historical data for what happens. This is the Fed fund rate. This is the interest rate basically looking at from all the way till now, back till COVID, back to zero, housing market crash, zero, all that kind of stuff, right? And each gray area we know is a recession. Woo! What happened in the 70s, from doing a lot of research, is that the Fed at this time period here was acting on impulse and not looking at the bigger picture. They would raise rates, people would freak out and panic, then they would cut the rates back. Then they would raise rates, then they would cut the rates. Right? So that's what was happening in the 70s, right? They would cut rates, they would raise them. They would cut them, they would raise them. They would cut them, they would raise them. Like, that's what they're doing. Like, look at that. Just up and down, up and down. Cut, raise, cut, raise, cut, raise. And people lost credibility in the Fed. So what happened is they hit multiple recessions, like back to back, a couple years apart, multiple recessions here. Then they had another recession in the 80s here because what happened? Paul Volcker comes in to the Fed chair position and he just jacks rates up to stop it. He's like, this inflation thing's we got to stop this here. So because there was so much lost credibility in the Fed in the 70s here, it was rate hikes, rate cuts, rate hikes, rate cuts, all because people were complaining and stuff like that. And it causes higher inflation. Inflation did not go away. Look at it. It was at like 5% here. You could take, or the rates were at 5%. Like, that's as low as they went. They didn't go down to this 1 or 2% rate, federal funds we're looking at here. So what happens in 1979 or 1980, one of the two, whenever Paul Volcker was put into the Fed office, Paul Volcker comes in and just jacks rates up 15%, 19%, pushes the economy down quick to cool off inflation, and then we kind of go on from there. Jerome Powell wants to avoid that at all costs. That's why he's saying here that we're not going to be subject to political pressure. He doesn't want to cause the same thing where Paul Volcker had to come in and just jack up rates to combat inflation because the Fed was doing whatever it wants. Jerome Powell is not going to be eased from political pressure. And think about it, right? Interest rates, this was, on my live stream on Wednesday, was 83% probability of the rate being the same. Now it's up to 91%. Rate cuts aren't happening. The Fed is sitting back and the Fed is waiting. The Fed is going to wait, and they're going to wait, and they're going to wait. And then Trump comes out and says, "Oh, it's going to be too late. The European Union cut rates. This is their 7th rate cut. They whatever." But Jerome Powell is not going to cut rates now, because the thing to think about and the thing to keep in mind about, if he cuts rates down, like down to here, okay, what does this do? Cutting rates is going to allow people to borrow money at a cheaper value. More money gets borrowed, then more money goes back into the economy, which is good. But what it will do is it will push prices higher. There's more spending happening in the market. The value of the dollar goes down because there's more money being pumped into the market. Value of the dollar goes down. What happens? Inflationary pressures happen again. We're not at the point where inflation can be controlled just yet, especially with this tariff uncertainty that we have here. These tariff uncertainties, we don't even know what's going to do to inflation. That's why I said, like, oh, it's transitory. Maybe it's not as transitory as what he thinks it's going to be. But if these tariffs push inflation higher, rate cuts will also push it even higher. That's a double disaster waiting to happen for pushing inflation higher. And you might get something like this. And Powell wants to avoid that at all costs. So it's just things to consider and something to think about. And there's one more thing to bring up here, which is this chart here. I took this from an article online here from the Bank of America Global Research. It's not the best quality, so I apologize. But it's the Global Equity Risk Love. It tracks everything here. And this is euphoria, where it's bearish. And then we have what's called capitulation, which is where there's massive sell-offs happening. When do we have it? COVID-19. Almost got there in 15 and 16. Not even close when we had tariffs the first time in 2018. This is your housing market right here. And then it comes back down a little bit again, a little bit later on here. But we still have some ways to go. We're still waiting to see that huge market sell-off that's going to happen. And I don't think we're there just yet. And again, it's at the 50th percentile of its history since 1987. So it's very, very, very low. It's bullish when we get down to the capitulation. When retail investors get out and they liquidate all the retail, that's when you'll probably see more of a pivot. So retail's still buying the dip every day. They're buying the dip. That's what they're told to do. They buy the dip. And this is why I'm sitting on cash right now, because retail keeps buying the dip. They keep holding the bag. And again, I'm not anywhere in any kind of comfort to say that we're going to be in a good spot between now and the end of the year. If you told me, Fridge, where were you at between now and December for how confident you are in the economy right now, I would say like a 1, maybe a 2. Luckily, me staying cash for the foreseeable future right now is very, very high. And I'm not trying to freak people out and be like, oh, I'm right. I would love to be wrong because recessions are devastating for people. And I would love to be wrong. We don't hit a recession, but signs right now are not pointing to good things right now for us. And that's where I'm kind of at this point in time here. So a lot of things we covered here. Again, if you look back at the economic data from the week, because I know I got to wrap it up here. We had something that came in that was kind of interesting and noteworthy for me. We had retail sales came in higher than expected, which was amazing. And I thought that was going to be a good thing for the market, but I think that this just further shows that people are panic buying now. People are buying up cars, they're buying up this, they're panic buying before tariffs hit because that's the fear you're seeing right now in the market. So that definitely doesn't help in this case. Very, very interesting. And again, here's job data. There's jobless claims came in lower than about 9,000 people, but continuing jobless claims were up about 41,000. So I don't know, guys. Thank you guys for watching so much today's video here. Again, GDPs, I don't know, that's a little bit better, I guess. But, thank you guys so much for watching today's video. If you made this far in the video, it's a very, very long and educational one that we're looking at here. But hopefully you found some insight of things. Again, I hope I'm wrong. I hope that we don't hit a recessionary period. But just kind of summarizing where we're at in the economy right now, I don't see any kind of turnaround happening in the near future here. So, again, hopefully you guys making money in the market some way, shape, or form, whether it's through bonds, indexes, high yield savings accounts, whatever it is. And as always, guys, I will see you in the next video.